This is not about artificial intelligence disrupting an old company. This is not about a Silicon Valley startup beating a legacy giant at its own game. What you watched happen on February 23, 2026, in real time, on live market feeds, inside the portfolios of millions of ordinary Americans, was the single most expensive overreaction in the technology sector in 25 years. $40 billion in market capitalization. Gone. In one trading session. Because of a press release. And the people who triggered it, the people who wrote the headlines, the people who hit the sell button without reading past the first paragraph, they are not going to apologize. They never do. I'm Laura Bennett. This channel exists because the story you are being told is always incomplete. We don't do panic here. We do documents, data, timelines, and the financial consequences that get buried under the noise of algorithmic trading and breathless tech journalism. If you are new here, subscribe right now because what I am about to show you is the clearest case study in market hysteria that Wall Street has produced since the dot-com collapse. Smash that like button. And drop a comment below answering this. Do you think IBM survives this? Or is this the beginning of the end? Tell me. I read every single one. Here is the argument I'm going to prove to you over the next several minutes. The IBM collapse of February 23rd was not a verdict on IBM's business. It was a verdict on Wall Street's attention span. It was what happens when algorithmic trading meets a headline that sounds terrifying, moves faster than human analysis, and punishes everyone who didn't get out in the first 12 minutes. IBM did not lose $40 billion in value because Anthropic built a better product. IBM lost $40 billion in value because the market forgot what IBM actually does. And the people paying the price for that amnesia are not the hedge funds who shorted the stock on the way down. They are the ordinary investors, the retirees, the pension funds, the long-term holders who watched their positions crater while the machines made their money and moved on. This is not about technology. This is about math, panic, and who always pays the bill when Wall Street gets it wrong. Let me take you back. Not to Monday morning when the headlines broke. Take you back further. Back to 1959. The United States Department of Defense needs a programming language that can run on any computer from any manufacturer without modification. They commission a team of engineers to build it. The lead architect is a woman named Grace Hopper, a rear admiral in the U.S. Navy and one of the most consequential programmers in human history. The language they create is called COBOL, Common Business-Oriented Language. It is designed to be readable. It is designed to be durable. It is designed to last. Nobody expected it to last 67 years. But here is the thing about durability. When something works reliably, at scale, under pressure, in the most critical systems on Earth, you do not replace it because a startup in San Francisco published a blog post. You do not replace it because an AI demo looked impressive on a Tuesday afternoon. You replace it when you have tested the replacement for years, when you have validated it against every edge case, when regulators have signed off, when auditors have certified it, when the lawyers have approved the liability framework. In banking, in insurance, in government, in airlines. You do not move fast and break things. You move carefully and break nothing. Because if you break something in a COBOL system running a major bank's transaction processing infrastructure, people cannot access their money. Flights do not take off. Social Security payments do not go out. That is the world IBM lives in. And that is the world that Anthropic just claimed it could automate with a press release. Receipt number 1. The number that should have stopped the panic before it started. 13.15%. That is how far IBM stock fell on February 23, 2026, in a single trading session. $223.35 per share at close, down from $255.97 at open. The worst single-day percentage loss IBM has recorded since October 2000, since the dot-com bubble, since a period so defined by irrational market behavior that we named an entire economic era after it. Let that land for a moment. The market just treated IBM, a 113-year-old company with $62 billion in annual revenue, $10 billion in free cash flow, and contracts with the majority of the world's top financial institutions, the same way it treated overvalued dot-com startups that had no revenue, no product, and no path to profitability. It treated Big Blue like a company that was one bad press release away from irrelevance. And the trigger was not a quarterly earnings miss. It was not a regulatory action. It was not the loss of a major contract. It was an announcement from Anthropic, an AI company, a privately held AI company, that its Claude code tool could help modernize COBOL systems. Could help. Help. Not replace, not eliminate, not automate entirely. Help modernize. Those two words, buried in paragraph 3 of the announcement, never made it into the headlines. The headlines said IBM is finished. The algorithms read the headlines, and $40 billion disappeared before lunch. But here is where the story gets genuinely interesting. And here's the part that the breathless tech journalists completely missed. Receipt number 2. The COBOL reality that nobody in Silicon Valley wants to talk about. There are approximately 800 billion lines of COBOL code currently running in production systems around the world. 800 billion. For context, the entire internet, every website, every app, every cloud service combined, runs on an estimated 111 billion lines of code. COBOL systems process an estimated $3 trillion in daily financial transactions. Every time you use an ATM, there is a statistically high probability that COBOL touched that transaction. Every time an airline books a seat, manages cargo weight, calculates fuel requirements, COBOL. Every time the U.S. federal government distributes Medicare payments, Social Security checks, military payroll, COBOL. This is not a niche. This is infrastructure. This is the plumbing of the global economy. And it has been running, quietly, reliably, invisibly, for decades. Now, Anthropic's Claude code has demonstrated that it can assist engineers in modernizing COBOL systems. That is real. That is genuine. That is a legitimate development worth watching. But here is what the $40 billion market reaction fundamentally misunderstood. IBM's COBOL business is not a software licensing model that evaporates when a competitor ships a better tool. IBM's COBOL business is a relationship model. It is built on decades of institutional knowledge, regulatory approval, legal liability frameworks, and the kind of trust that only gets built when you have not caused a single catastrophic failure in 30 years of running mission-critical systems. A bank does not switch its core transaction processing infrastructure to an AI tool because the demo was impressive. A bank switches its core transaction processing infrastructure after 2 to 3 years of parallel testing, regulatory review, third-party auditing, and board-level sign-off. IBM's sales cycle for these engagements is measured in years. The threat from Claude code, if it materializes at all, will materialize over years. The market priced it in over hours. That is not analysis. That is panic. Here is where I need to step away from the market data for a moment. Because there is a real person in this story, and his name is not Larry, and it is not Jensen, and it is certainly not Dario. His name is Robert. He spent 31 years at a regional bank in Ohio, the last 18 of them in the IT infrastructure division. He retired in 2019 with a pension, a modest 401k, and a direct stock holding in IBM that he had been building for over 2 decades. Reinvesting dividends, buying on dips, the slow and steady accumulation of a man who believed in the company that built the computers his bank ran on. At market close on Friday, February 21st, Robert's IBM position was worth approximately $94,000. By market close on Monday, February 23rd, that same position was worth $79,400. $14,600. Gone. In one trading session. Not because IBM's business changed, not because IBM lost a contract, not because IBM's revenue declined. Because Anthropic published a press release and the algorithms did the rest. Robert did not get a margin call. He did not panic sell. He sat on his hands, the way long-term investors are supposed to, and watched $14,000 evaporate. He is now watching analysts argue on financial television about whether IBM's mainframe moat has been permanently compromised, and he is wondering whether the 31 years he spent understanding the technology that his bank depended on actually count for anything in a market where a headline can erase 2 decades of patient investing in an afternoon. Robert is not alone. IBM has approximately 344,000 individual shareholders. Many of them are retirees. Many of them chose IBM precisely because it was supposed to be the boring, stable, institutional-grade holding that did not do this. Now let us talk about the pattern. Because this is not the first time Anthropic has done this, and that fact is not a coincidence. Receipt number 3. The Anthropic Disruption Playbook, and why it keeps working. 3 weeks before the IBM collapse, Anthropic announced new security capabilities within Claude Code. The market response was immediate and brutal. Palo Alto Networks fell sharply. CrowdStrike fell sharply. 2 of the most established names in enterprise cybersecurity, companies with multi-year government contracts, Fortune 500 client relationships, and revenue visibility that most startups would trade their entire cap table for, saw billions in market value erased because Anthropic demonstrated a security feature in a product demonstration. Not a shipped product, not a production deployment, a demonstration. The month before that, the launch of Claude Code itself triggered a broad sell-off across enterprise software stocks. Companies that had nothing to do with the specific capabilities Claude Code demonstrated fell because the market decided, in aggregate, that AI was going to eat software and everything should reprice immediately. This is the Anthropic Disruption Playbook, and it follows a precise, repeatable structure. Step 1. Announce a capability. Step 2. Frame that capability in terms of what it threatens, not what it does. Step 3. Watch the algorithms read the threat framing, sell the threatened sector, and generate headlines that amplify the sell-off. Step 4. The capability ships, proves useful but not existential. The sector recovers, and Anthropic has secured another cycle of earned media and market attention worth hundreds of millions of dollars in advertising equivalents. I am not saying Anthropic is doing this intentionally. I am saying the pattern is there. I am saying the market keeps falling for it. And I am saying that the people who pay the price every single time are not the institutional investors who shorted the sector on the way down and covered on the way back up. The people who pay are Robert. Every time. Here is what I want you to really sit with, because this is the moment where the comfortable narrative about AI disruption falls completely apart. IBM's senior vice president Rob Thomas said something after the collapse that was entirely correct and almost completely ignored. IBM's mainframes, he noted, support every major programming language, not just COBOL. The value of IBM's infrastructure is not in the language. It is in the reliability, the security certification, the regulatory compliance, the contractual liability framework, and the institutional relationships that have been built over decades. If clients automate their COBOL modernization, IBM's mainframes still run the modernized code. IBM's consulting division still manages the integration. IBM's security division still certifies the deployment. The revenue model shifts. It does not disappear. Jefferies understood this. The investment research firm maintained its buy rating on IBM after the collapse, with a $370 price target, implying more than 60% upside from Monday's close. 60%. That is not a firm that thinks IBM is finished. That is a firm that thinks the market just created a significant buying opportunity because the algorithms panicked and the headlines lied. But here is what Jefferies cannot do. Jefferies cannot give Robert his $14,600 back. Jefferies cannot undo the psychological damage of watching 2 decades of patient investing get cut in an afternoon. Jefferies cannot fix the fundamental problem with a market structure that allows algorithmic trading to move faster than human analysis, punishes patience, and rewards the kind of short-term reactivity that produces exactly this outcome: over and over and over again. So here are the 3 paths forward, and I want you to think about these carefully. Path 1. The market was right, and IBM is structurally impaired. COBOL modernization accelerates faster than anyone currently models. IBM's consulting revenues compress significantly over the next 3 years. The mainframe business enters a secular decline, and the $370 price target from Jefferies turns out to be fantasy. In this scenario, Monday's 13% drop is not the overreaction. It is the beginning. IBM trades into the 150s by 2028, the dividend gets cut, and Robert's patience turns out to have been misplaced trust in a company that could not adapt fast enough. Path 2. The market overreacted, but IBM's structural position is genuinely weaker than it was. COBOL modernization does compress some of IBM's highest margin consulting revenue. Not catastrophically, not existentially, but meaningfully. IBM's growth trajectory slows. The hybrid cloud and AI pivot, which IBM's leadership has been executing for 3 years, does not generate revenue fast enough to offset the legacy compression. The stock recovers partially but never returns to its November 2025 high of $314.98. IBM becomes a value trap. Solid dividend, modest growth, permanently re-rated downward. Path 3. Monday was a pure panic event with no fundamental basis. IBM's business is exactly as strong as its most recent earnings report indicated, and in 12 months the stock is trading at or above $300. The COBOL automation threat proves real but manageable. IBM's own Watson X code assistant competes effectively. The institutional relationships that took decades to build prove more durable than a press release suggested. Patient investors who held through Monday's session, or who bought the dip, are rewarded. Robert's $14,600 comes back. I want to believe in Path 3. The fundamentals support Path 3. IBM's most recent quarter beat estimates. Revenue grew. The AI business is accelerating. The Confluent acquisition adds cloud data infrastructure capability that the market was pricing positively just 6 weeks ago. Path 3 is the rational read of the available evidence, but I have been watching what algorithmic trading and AI panic headlines do to rational evidence. And I know that in a market where a press release can erase $40 billion in an afternoon, rational evidence is not always sufficient to protect the Roberts of the world from the next panic cycle. Because the next one is already being written. Somewhere in a San Francisco office, another capability is being prepared for announcement. Another sector is about to be told it is obsolete. Another set of algorithms is about to read a headline faster than any human can respond. And another Robert is going to watch his retirement savings take the hit. Here is what I want you to take from everything you just heard. IBM is not finished. IBM's business did not change on February 23rd. The plumbing of the global economy, the 800 billion lines of code, the $3 trillion in daily transactions, the airlines and banks and government agencies that depend on mainframe infrastructure, did not become obsolete because Anthropic published a blog post. What changed on February 23rd is that the market revealed, again, exactly how it works. Fast money moves first. Headlines amplify. Algorithms accelerate. And the patient, long-term investors who built positions in fundamentally sound businesses pay the price for everyone else's panic. The people who made money on Monday were not the people who understood IBM's business better than the market. They were the people who shorted the sector when the headlines broke and covered when the dust settled. They did not know more. They moved faster. And in a market structure optimized for speed over analysis, faster always wins in the short term. But here is the thing about the long term. The long term is where Robert lives. The long term is where pension funds live. The long term is where the fundamentals eventually, always, reassert themselves. IBM has been here before. In the 1990s, IBM was written off as a dinosaur that could not survive the PC revolution. It survived. In the 2000s, IBM was written off as a hardware company that could not compete in the services economy. It pivoted and thrived. In the 2010s, IBM was written off as a legacy IT company that could not compete in the cloud era. It is still here, still paying its dividend, still running the infrastructure that the global economy depends on. The question is not whether IBM survives this. IBM will survive this. The question is why we keep building a market structure that forces Robert to survive it too. Drop your answer in the comments. At what point does Wall Street's panic machine become a public policy problem? Subscribe because the next disruption announcement is already in motion. The next sector is already being targeted, and you need to understand the playbook before the algorithms read the headline. Share this with every long-term investor you know, because the story of IBM and Anthropic is not over, and the next chapter starts the moment the next press release drops. The market forgot what IBM does. IBM has not forgotten. And 67 years of COBOL running the world's money is not something a demo video replaces before lunch.